Good morning, friends. Welcome back to IC38 learning modules. Very happy to continue these sessions and ensure that you are clearing the mandatory examination successfully. Let's keep the learning on, reiterating for your benefit. All the modules have been discussed, designed in such a way that the basics become stronger, and in addition, you clear the mandatory examination. Right. So let's continue learning. We are in the fourth chapter now, which speaks about life insurance products, non-traditional in nature. Right, we have already covered the first three chapters where you saw about life insurance, what life insurance involves, financial planning in detail, and different products of life insurance which are traditional in nature. So, chapter 4, we will discuss life insurance product non-traditional. So what is this non-traditional, right? So let me give a quick brief about this word non-traditional alone before we continue with the segment, right? So traditional products were typically a savings product where there was an element of either endowment kind of a product which you saw that the customer saves for certain number of years and then finally gets the benefit of the product as a maturity benefit. And here we also saw protection plans which was part of the traditional products, right? So what is this non-traditional? Typically focusing on the investment returns, giving a different approach to increasing the savings in life insurance as a segment, right? So let's continue understanding more about non-traditional products. So first, let's see why. What were the limitations which were existing in traditional life insurance products? First and foremost, the rate of returns and the profits were not transparently shared to the customer. So similarly, in addition to rate of returns or the profits, the expenses in a particular traditional product or what is the cash value component was not clear to the customer. So and the understanding surrender value was a challenge. Yields typically were in line with what the market returns were as far as a debt product was concerned. So yields were low in traditional life insurance product. This pushed the market experts to explore options about non-traditional products. So in general, the different features to give in a nutshell, non-traditional products are directly linked to the equity markets. So the returns will can necessarily beat the inflation. Premium and death benefits can be decided flexibly, and a better surrender value was available in these non-traditional products. So since these products were linked directly to the market, so the returns were directly proportional to the performance of the equity market of that particular country, right? So non-traditional markets, let's discuss the two different types of non-traditional life products for your understanding, right? And then probably we will discuss a little detail about one of the non-traditional product, which is unit linked insurance. So the other non-traditional product is universal life and variable life. These are the variable life insurance products. So give a brief about these two segment of products. Universal life policies were first introduced in US in 1979. The premiums and the death benefits were flexible. Customer had the option to choose the both. So these were the basic crux of a universal life policies. Similarly, variable life policy introduced in 1977. Typically, it was a whole life policy model, and death benefit and cash value fluctuates according to the investment performance. So customer chooses a variable life policy, it goes into investment, and based on the returns, the death benefit and the cash value benefit were fluctuating. So actually considering the fluctuation in the returns nature, IRDA discontinued and did not allow life insurance companies to sell a universal life policy or a variable life policy since 2019, keeping in mind the benefit of the customer, right? So the new kind of policy which is available now are unit linked insurance plans, also known as ULIPs. These were first introduced in UK in the 1960s, and these products have started competing with the traditional life insurance plans, right? So what are these unit linked insurance policies? The premium paid by the customer goes to investment in the equity market, and in addition the product also gives a customer a insurance cover, right? So friends, when you're talking about products, when you're talking about the history of a product, how it came into existence, you should also think in line of two aspects. One is how a question can come in your examination, and the second one is when you're meeting a future prospect, if he's questioning you on ULIP, you should be having an answer for it, understanding the product which you're taking to him as a discussion, right? So coming back to our discussion on ULIP, right? So ULIP provides insurance, that's what we saw, and ULIP takes care of investment angle as well. So the charges which are paid for the insurance and for the expenses are very clearly mentioned in the illustration. So after deducting the charges, the premium goes for investment. A customer decides to invest a lakh of rupee, and if by the feature of the product we say that 2000 rupees is for charges and 1000 rupees is for insurance cover, 3000 rupees is deducted and 97,000 goes for investment in ULIP for the customer. So whatever returns they get from the market for the 97,000 invested gets added to the product kitty, and that becomes the customer's benefit. So in a nutshell, the risk of returns is borne by the customer here. And moving forward, just to represent graphically ULIP premium, whichever premium a customer decides to invest goes for investment after deducting the expenses and mortality. What is this mortality? A new term has come in here. Mortality is nothing but the charges levied on a customer towards the protection plan, protection value we are giving in as an add-on cover in ULIP, right? So ULIP premium comes for investment, expenses are deducted, mortality premium is deducted, and the rest goes to investment, and however the market is performing, be it profit or loss, is given back to the customer, right? So how do we calculate a net asset value? It directly reflects the market value of the total assets. So NAV is calculated as total market value of assets of the fund. Whatever kind of volume of assets we have, that is added together and divided by the number of units in the funds. On a daily basis, NAV are declared and it is being published so that the customer is aware that I have 100 units, I have 1000 units, and my NAV value is 10 rupees each or 20 rupees each. On a daily basis, plus minus happens, and he knows his total asset value in the market, right? So adding more to unit linked insurance, the customer gets a choice of selecting the fund in which he has to invest. Unit link does not mean the investment is happening only in equity. He can also choose a fund which is debt in nature, or he can also choose a fund which is a mix of debt funds and equity funds, right? So this is if you recall the previous slides, we said there is a total premium, mortality charges is deducted, other charges are deducted, and the balance goes to investment. And now the customer also has an option to select which fund he wants to invest. So different funds are highlighted here. Equity fund, where the investment goes into the equity related instruments in the market. Debt fund investment goes to government bonds, corporate bonds, fixed deposits, majority should we say guaranteed in nature. right? So balanced fund is a combination of equity fund and a debt fund, and a money market fund is investment happens in treasury bills, certificates of deposit, commercial papers, etc. Right, so the various fund options available to the customer. Again, if you ask, should the customer choose only one fund? Not necessarily. For instance, if there is a company which is giving a unit linked product with these four funds, the customer can choose to invest 25% in every fund, or he can choose to invest 50% in one fund, 10% in one fund, and 40% in the other. So whichever way he can choose, flexibility of choosing the funds are there. Last, to give a nutshell about unit linked insurance, unitizing. First, the unit linked, as the name says, it is unitized on a daily basis. You will know your NAV values. So NAV determines the benefits under ULIP. What is your asset value? Transparent, charges and expenses are clearly understood by the customer. Pricing, the insurer decides the amount of premium to contribute for death benefits, and death benefit, and the balance goes to investment. Right? Pricing, the insurer decides on the amount of premium to contribute, and the balance goes for investment. Death benefit, of course, if there is a death of the policy holder after taking a unit linked plan, either the sum assured or the fund value, whichever is higher, is given to the nominee. So unit linked funds, as discussed earlier, comes with the death benefit as well. And lastly, the point to be noted here, the investment risk is borne by the customer. So what we mean the investment risk is, if he chooses a equity fund, so he is deciding to take the higher risk so that he can get a higher return. Similarly, he can also say, I do not want to take any risk, give me a debt fund, which is still possible, right? So lower the risk, lower the returns. So this is unit linked insurance for you. Friends, we understood about non-traditional life insurance products in this chapter. There is a Q&A video for you. As always, have a look at the sample questions. The possible probable questions in your examination are given as in the sample Q&A video. And reiterating, in addition to watching this video which covered the contents of chapter 4, in addition to watching the Q&A video, you should also spend time in reading the IC38 book and understand more in line with your examination and addressing the questions of your future prospects. So good luck to each one of you. All the best. Stay connected. Let's move into chapter 5 and let's keep learning.